Hey, everybody. Here we are today at the mothership with Clark Communications in our podcast studio. We've got a special guest with us, Joel Arndt from Sherwood Mortgage Group. Joel, welcome.
Hey, thanks for having me.
Love to have you. Listen, a little bit about Joel. He was raised in North Bay and Mattawa, but he spent the last probably 7.5 years in Hamilton, my home stomping grounds back in the day.
Nice.
And he was a marketing manager for a realtor team. But now he's back up in the Bay, enjoying the fresh air. Welcome back to North Bay.
Thank you.
Glad to have you.
Yeah, closer to family, closer to clean air, for sure.
That's awesome. Okay, so look, we're going to open this up. We're going to talk a little bit about mortgages, but coming from the business side, so for business owners.
Yeah.
So I've got a bunch of different questions that I wrote down here, and I want to just kind of tackle them one by one if we can.
Yeah.
Okay, so the first one is basically, how is qualifying for a mortgage different as a business owner compared to being an employee?
It comes down to documentation requirements. So, as an employee, basically, you're going to need a letter of employment, pay stubs, at least one tax form, like year-end tax form T4. And as long as those line up, you're set. As long as there's no glitches in those documents, it's fairly easy to qualify. For a business owner, usually they want at least 2 years history in business, profitable history. And that obviously that's tough for new business owners starting up, or it's also tough for any business who've seen rough times. And they take, and so if, I'm taking either the average or the lowest, if I don't want to get too technical, but we have to average things out. And another big difference is when I'm using a T4 employee, or when I'm using T4 income from an employee, we're using gross income. When I'm looking at pay stubs for a salaried person, I'm using their gross pay before deductions. Okay. Whereas for a business owner, it's always net income. So after write-offs. So now with business owners, we have this weird conundrum where they don't want to, we don't want to pay too much taxes, and we want to save money on taxes, so we write off as much as we can. But if we want to qualify for a house, now we're not showing as much income, and it's harder to qualify because. So now there are ways around that, and that's where I am passionate about helping people. First of all, understanding the business, because that really goes a long way to understanding how the money flows. Because if I can understand how your money flows, then I know how to sell this to the lender.
Gotcha.
And and then I know, okay, you've been writing off these expenses. Guaranteed, some of them aren't necessarily strictly business expenses, especially for the independent contractors or just new business owners who've just started and working out of their home, or any business owner who works out of their home. There's a lot of home expenses, personal expenses that we could actually add back onto that net income. But there's a whole bunch of other little avenues to get in there. But those are the biggest differences. Is we have to use net income for a business owner, and we need the 2 years history usually. Again, always ways around this stuff, but that's the basis. Interesting
stuff. Yeah. You're right. You try to minimize and write off as much as you can, but that diminishes the bottom line, and they want to see a profitable bottom line. So I understand it gets a bit more complex.
Business owners coming to me asking, how much do I need to write off, or how much should I claim? And this is smart. This is the next step for most business owners. Once they realize, they probably went through one tax, you wrote off everything, went to buy a house and realized they couldn't qualify. So the next year they're like, okay, we're going to be smart and go and ask. And I can give you numbers. I can say, look, if you claim this much, I can ask for this from a lender, but I am not a tax, I don't know what that's going to mean for your taxes. Yeah. So that's where it really helps if I can work together with your accountant, and it is so important to work with an accountant. And to help okay, what's the balance between not paying too much on taxes versus qualifying for a mortgage, or qualifying for a better rate. Sometimes it's just the difference between a good rate or a more expensive rate. So
makes total sense. Okay, next, how do we save on taxes but qualify for the maximum mortgage amount?
We led into this a little bit, so it comes down to. What do you, again, working with a professional accountant, what do you need to see at the end of the year? Okay, actually, I'll backtrack a little bit.
Yeah.
What kind of house do you want, right? What kind of house are you hoping for? What kind of income are you going to need to claim to qualify for that house. Okay, so that's the first step. The next step is, do we have to claim or do we have to claim all of your income or even a large portion of your income? Are there expenses, whether it be home expenses or stuff that's like not material, capital cost allowance. Let's say you're equipment heavy business, and so you're claiming a lot of capital cost allowances, which aren't actual expenses. You're not paying out of pocket for that stuff for the most part, but you get to claim it, a portion of the depreciating value or something over each year.
Yeah.
So we can add that back on. So if that's heavy in your business, well then that's something that I'm looking at to say, okay, we can throw that back onto your income, which means you don't have to claim that much. And so that will save on taxes. So that's the balance there. And then it's a conversation with the accountant of what tax bracket are they going to be in? What's this going to mean for them? And I don't necessarily have to know that. It's just like I can go to the accountant and say, this is what we're hoping for. How do we get them there and save on the taxes? So I can help with the half of how do I qualify? How much do I need to claim to qualify? And then the accountant comes back with this is what you need to do to save.
Yeah. So it really sounds like you have to have a team. You need yourself as a professional business mortgage person, and you need a CA or an accountant or someone who can educate you on the other portion of it, which is taxes and how it should look.
I think as entrepreneurs, that's one of the hardest things to accept sometimes for some personality types in business because we're so used to doing it ourselves.
Yeah.
And we want to save money. Now, the beautiful thing about my service is it doesn't cost you anything. I get paid by the lender. So I'm free for you.
Right.
But obviously the accountant isn't free. But I would always argue that accountants worth their weight in gold when it comes to, especially one that knows business and stuff like that. So yeah, 100%. You need the team of reliable, competent individuals who know your niche.
Would you add a lawyer into that mix as well?
100%.
So yeah. Okay.
Yeah, definitely. Like general business, dealings. You're probably not going to need to talk to your lawyer too often, but you want someone who you're comfortable with that, because incorporation, when you go to incorporate, you're going to need a lawyer. You're going to need an accountant and a lawyer.
Yeah.
Buying any kind of real estate, you're going to need a lawyer.
Gotcha.
And liability, anytime there's a liability question, obviously a lawyer. And that's a big, especially if you are either handling risky equipment or if you have a lot of employees or if you are servicing, like if your business relies on, so like I think of a coffee house where you wouldn't think you need a lawyer as a coffee house, but if you own the property or if you're responsible for the property around your coffee shop, and there's any potential for, and I'm getting way out of my purview now.
Yeah.
So, but yes, short answer, yes.
Add a lawyer to the team for sure. Okay, love that. Is it easier to qualify for a mortgage if a business incorporates?
Depends on how they're paying you. So or how you're paying yourself.
Okay.
If you are paying yourself T4 income from your corporation, that's pretty easy. It's not always necessarily the most tax advantaged. Usually people will incorporate and pay themselves dividends, which we can use. Dividends aren't as reliable in a lender's eye as T4 income is, but it's still usable. We can use like a 2-year average of whatever your dividends are. And usually it's a mix. Again, this is where a conversation with the accountant comes in, because like, how do we save taxes and pay myself reliably? It's going to be a mix of dividends, T4 income, whatever the heck else tools they have. I'm not familiar with all of them, but I know those are the two most popular. And so once you incorporate, it's definitely easier as long as how you're paying yourself is well documented, if that makes sense.
Okay.
Like you're not just taking owner draws or something like that. Like you're actually they're dividends, or it's a regular paycheck or something.
Okay.
And it can, and then it's easier also because now you've got like corporate financials that are being prepared by an accountant as well, and those help a lot in proving the stability of your business, the profitability of your business.
Right. Yeah.
All that jazz.
Interesting. Okay. Talking to a lot of business owners, they talk a little bit about pulling some equity from their home
Mm-hmm.
and helping and using that to finance their new business.
Yeah.
Talk to me about that. Is that a good strategy?
Really depends on the interest rate. Now, mortgage debt generally is the cheapest interest rate you're going to find. And so I would say it's probably the best first approach, best first option.
Okay. Yeah.
Take a look, because you just want to be careful that you're not, we just had a conversation about this before the podcast. We are so used to betting the house for our business as business owners, as entrepreneurs.
Right.
And that instinct really, and the insane work ethic that entrepreneurs have really is the winning edge. But it can also get people into so much trouble if things don't pan out, right?
Right.
So the question isn't should I, it's are you willing to deal with the consequences if this fails?
Oh, that's good. Okay. Yeah.
So I can do it for you. And it's going to be cheap. It's going to be cheap debt. But how's the cash flow of your business right now?
Yeah.
What's the future cash flow look like reasonably with whatever upgrades you're going to do for this, or even investing in a new business? Like what is it reasonable to expect going into this in terms of cash flow? Is the business going to be able to afford this? If it can't, that's fine. Understand that you're paying out of pocket for 6, 12, 18 months, maybe 2 years. Can you afford that?
Right.
And those questions have to be asked.
Interesting. That's good stuff. Okay. 2-part question.
Sure.
Number 1, what is the 2-year rule?
Yeah.
And number 2, how does a business owner bypass the 2-year rule?
So the 2-year rule comes from this need that lenders have for stability. They want to know that you've been in business for a while, you've got your feet under you, you have an established client or customer base, and you're profitable. They want to see 2 years T1s, which are the general like tax forms that accountants will give you once they've filed everything, and that breaks down your entire tax filing, and that has a really nice little section in it called a statement of business activities. Doesn't probably matter to you, but it matters to me a lot,
right?
And because I can see what you're writing off, and it immediately triggers certain questions for me to ask about your business and how it runs and how the cash flow works and stuff like that.
Right.
And they want to see 2 years of those T1s, and then they want to average that out and stuff like that, just to get the baseline or a reasonable assumption for how your business is performing. How do you get around it? There are programs, most notably the CMHC BFS Business for Self Enhanced program, that will. And CMHC is the Canada Mortgage and Housing Corporation. They backstop mortgages for anybody who isn't familiar with them.
Right. And you pay a fee for that though, right?
Yeah, absolutely. So technically, a little history on CMHC. So technically, the lenders pays the fee. The customer actually, or the client borrower, doesn't actually come into the picture anywhere in CMHC's thing. But it's just become an industry norm for the lenders to pass that on to the borrower. Yeah. And what happens is, in Canada, you have to make a minimum. You can't buy a property with less than 20% down unless you insure the mortgage from default. So this is where CMHC comes in, and 2 other companies. They insure the lender against default. So you stop making your payments. Lender does the default procedures. They go to CMHC, make a claim, get money from CMHC, whatever, and you sell your house, whatever. It's just like, it's this whole thing. Yeah. You pay for that. And that allows you that, then with that in place, with that insurance in place, the government is now comfortable with you putting as little as 5% down. And that's the minimum in Canada.
Okay.
CMHC also does this program where for business owners who I've only been in business for 6 months, for a year, for 18 months, who don't have that 2-year record. Yeah. They say, okay, we will insure this mortgage for this business owner given certain parameters. The biggest parameters, do they have a history in the industry? They're a dentist. They maybe they worked as a hygienist before, or they have even the schooling. Like they don't even necessarily have the work, but they've got the schooling under their belt. They want to open up a practice. And they're buying a building that will also be their home, or a contractor, a general contractor. They've worked all their lives for their dad, who or someone else as a carpenter and doing all the trades and stuff like that. And now they want to branch out on their own. They have the capital, but they did, but maybe 6 months ago, but now they want to buy a new house. Business is going great, but they only have 6 months history. Well, they've been a contractor all their lives.
I see.
So that history makes the CMHC and the lender a little bit more comfortable with taking a risk on them. The other piece is contracts. So this is really popular for IT consultants.
Okay.
Do you have ongoing contracts? That's always a great thing. If you've got a year-long contract that's set to renew.
Oh, that's good. Yeah.
It's a lot easier to bypass that 2-year mark because the lender just wants to know that you're going to have income in the next few years, right?
Right. Yeah.
So a contract goes a long way, or for sometimes for like landlords, do you have a lease in place? If you're a professional landlord.
Yeah.
Anyway, so that's
very interesting. Good stuff. Okay, listen, common mistakes that business owners make when seeking a business mortgage. Can you list out a few that we can let the audience know?
First one is set proper expectations.
Okay.
And that's tough. I think that really comes with conversations with a professional.
Yeah.
And just give me a call and say, hey, look, this is roughly my situation.
Gotcha.
I can't give you an idea of like what, how much you're going to qualify for, but I can tell you what the rate environment is. And I can tell you based on, that high level view of your situation, what kind of documentation we're going to need, or if we're going to have to look at an alternative lender versus an A lender and that kind of thing. So that's set expectations. That's a big piece. The second piece is have your finances, your business finances separate from your personal finances. Now that's tougher for a new business owner. If you're not able to make that investment up front, that can be, it's not that it can't be done. All the time I'm getting bank statements from people and it's their personal bank statements as well as their business bank statements, but it's harder to parse through what's personal and what's business at that point.
Yeah.
And it's just more work. And if the lender questions anything, it's just easier for the lender to question things at that point too.
Yeah.
Right?
Yeah.
So if your finances are separate from, and when I say finances, I basically mean your credit cards and your bank account for the business. If they're separate from your personal, well, it's a lot easier to distinguish what's business and what's personal.
Gotcha.
And there's less for the lender to question. And it makes my job easier.
Yeah. Oh, for sure. Yeah. So keeping personal from business totally separate. That means credit cards too. Keep a business credit card.
Yeah,
keep
absolutely.
A personal credit card.
Because especially if you're using credit card to pay for expenses, right? Because if you're not necessarily paying yourself a salary or any kind of specific wage or dividend, then we do there are specific expenses that even though you're writing them off on your year-end taxes, we can still add them back into income later on when it comes time to qualify. And that's a lot easier to do if we don't have to filter through a lot of personal stuff.
Gotcha. Makes total sense. Okay. So do you provide like a consultation to business owners if they're looking to do something with the mortgage? Can they just give you a call? If so, how do they reach you? Who should they call? That sort of thing.
Absolutely. So my number is 705-358-5635. Feel free to call or text anytime. I mean, I may not get back to you right away necessarily. I might be with my daughter or something, but I am happy to answer questions because I know that this is such an education gap. And but again, it's not something you really think about or want to think about until you need it. So it's once you do start thinking about it, having that conversation before you even start making offers, or really before you even start looking at houses. I know the houses are the exciting part.
Right.
But regardless of where you are in that process, totally do a consultation. If what's probably going to end up happening is you call or text me, I'm going to say hi and ask you a few questions, and then I'm probably going to send you a Calendly link so that we can sit down and have a Zoom call or phone call or coffee and talk particulars. And and that way we can dedicate time to it.
Okay. And if that business owner already has a home, but now he's looking at purchasing a commercial building. Yeah. Can he still go through you for all that?
Yeah, absolutely.
Okay.
I will say buying commercial right now is an interesting feat. In November, December, I remember going to two lenders who had commercial divisions, asking them about certain properties in town, knowing that they were probably going to need some exceptions, and got a reply back saying they had closed down their commercial division.
Wow.
Commercial real estate is not doing great right now. I don't know about Canada. I haven't actually looked at the stats in Canada, but I know globally it's suffering the most.
Gotcha.
In terms of like corporations have had a hard time carrying corporate commercial real estate debt loads, and they're just defaulting.
Right.
Now,
wow.
So that, what does that matter? Whoops. So what does that matter for the individual business owner now trying to buy a commercial property? Well, it means lenders are skittish.
Right.
So it means the qualifications to buy a commercial property
are going to be up.
Exactly.
Gotcha.
You got to have like 5 years sometimes. Yep. And it's got to be a very valuable property sometimes. There is one lender I know of right now that will go below $1 million value. All the rest want at least $1 million. Some want $5 million or higher.
Wow.
It's got to be worth the investment to them. So it's not that it can't happen. It's just that like we have to have all of our ducks in a row if we're going to go for like retail, light industrial, office, whatever.
Yeah. So it's much harder for a business owner to secure a mortgage on a commercial property than it would be on a residential property as a business owner.
Yeah, definitely.
By far.
If there's residential mix, it's a little easier because there's I'll say relative safety in the residential income. So if it's a mixed use, that's easier. And if your business is going to be operating in then it is that's a little easier just from the sense that like you have all of your financials, gotcha. Right? We don't need to get financials from some other business that's coming in to, so.
Interesting stuff. Any parting words, any thoughts, anything we might've missed on? I mean, this is great. I love having you here. You're so smart and knowledgeable in the mortgage space for business.
I appreciate that.
Yeah.
Parting words. I think it sounds scary. If you want to save yourself some work, keep a dedicated file for all of your business stuff. And and that sounds like so, you're like, sure, of course I'm doing that.
Yeah.
But then you actually go to get the files and you're like, oh shoot, where did I put that? I'm saying that because that's what I do. Right.
Yeah.
Like when I started my business, I have a file. Did I put everything in that file? Heck no. But, so like, it's even something I have to get better at, but having that, and this kind of goes along with keep your business separate from your personal finances. It's just the easier you make it on yourself to do this legwork, the less daunting it's going to be. Right. And when surprises come, they won't be as stressful. That's something that I'm really big on. I want to do this legwork up front. People are like, why do I need to give you all this documentation? Because I have a general sense for what the lenders want anyway. This is what they're going to ask for no matter what. Yeah. Let's do our homework now. Let's use a Wayne Gretzky quote. Yeah. Let's skate while we don't have the puck.
Yeah.
So that when we finally get the puck on our stick, we can just fire it off.
Right.
We're ready.
Yeah.
But if we're scrambling, it's not that we can't get it done. There's just a lot more stress. So let's save you some stress. That's all.
Makes so much sense. Back in the car business, same thing for financing a car.
For real.
You got to get your ducks in a row beforehand so that when you do present to the lenders, you've got everything that you need. So this has been awesome. Again, this is Joel Arndt with Sherwood Mortgage Group. And you can reach Joel at 705-358-5635. And this is, again, we're podcasting from Clark's Mothership. And this is your business podcast from North Bay. I'm Paul Meyers. And Joel, thanks very much for joining us today.
Paul, you're a star. Thank you.
Thank you. Bye-bye.